Coach Matt from Tackle Trading to give you a video on the definition of a lower low, lower high. The lower low, lower high is a technical formation that we consider a continuation pattern. It is very similar to the bullish continuation pattern, higher high, higher low. Flip that chart upside down and all of a sudden it is now a lower low, lower high. It is a pattern that we are looking to short the stock or potentially buy put options in what is known as a bearish swing trade. Now, continuation patterns have a tendency to repeat themselves until they form a reversal pattern. Once again, the core 1, 2, 3 pattern on the downside is what we call a lower low, lower high. Now, in looking at the lower low, lower high, you have a clearly established bearish downtrend. But what creates the bearish downtrend is breaking of support. The breaking of support is step 1 in the bearish 1, 2, 3 pattern, lower low, lower high. Once that stock breaks support, the stock will continue to come down in price until it finds support again. When it finds support, you will see a slowing momentum candlestick, which is typically defined by a small candle range, otherwise known as a star class, a Harami class, or a doji class type of candlestick formation. That is pattern number 2 in the bearish downtrend. It's what gets what we know as overextended to the downside. And you can identify overextended based on historical pay ranges, historical trend lines, significant whole numbers, those types of techniques that help us identify how far a stock will move in the future. Once it gets overextended, traders start buying back the stock. That drives the stock back up into pattern number 3, which is called the bearish retracement. And the bearish retracement is a very consistent bearish pattern where once again you are looking to short the stock or potentially buy put options. Now let's look at this pattern a little more simple. Now, in terms of the pattern first starts with, once again, the breaking of support. The breaking of support will typically create a big wide-bodied candlestick, where the range is typically a little bit bigger than the historical ranges of the stock. That will continue to drive the stock down until it gets overextended, creating the first lower low, lower high, lower low, lower high. This pattern once again will repeat itself until it forms a reversal pattern, otherwise known as a W formation or an inverted head and shoulders formation, which we will cover in later videos down the road. Now, in terms of this pattern, once again, you're looking to short the stock or potentially buy put options if you understand how to trade the options market. Now, let's take a look at one quick example. Here is an example of Dana Incorporated. The symbol is DAN. As you can see right here, you have a nice little sideways trend, very clearly established support levels, a very clearly established resistance level here at 27, support right here at 25. As you can see, as the stock is approaching that support level, it slows down right into there with those narrow body candles. But as you can see right here on this earnings announcements, which can typically break support or break resistance, you saw that big red candle breaking down out of resistance, gets overextended to the downside at 23, and then it simply forms the pattern. It goes lower high, lower low, lower high, lower low, lower high. The projection, once again, if this pattern does continue, would be to the next lower low. And we are going to trade the pattern until the pattern changes. Step 1 in the pattern is the breaking of support. Step 2 in the 1, 2, 3 bearish formation is it retraces back up into resistance. As you can see, this old support level becomes now a new resistance level. It gets overextended, then it just continues the pattern until it doesn't. This is Coach Matt for Tackle Trading. If you'd like the video, go ahead and give it a like on YouTube. And thank you for watching.